Value Trade Price Action Strategy webinar series. This evening, we're going to look at market and chart patterns, and my name is Paul Wallace. Before we dig into the main body of work we'll talk through this evening, as always, we'll begin with a quick risk disclaimer. CFDs and FX are leveraged products and carry a high level of risk to your capital. It is possible to lose more than your initial deposit, and you may be required to make further payments. These products may not be suitable for all clients, so please ensure you fully understand the risks involved. So as I said tonight, it's the next stage in the Price Action Strategy webinar series. And what am I going to cover this evening? What I'm going to talk about is a basic introduction to market and chart patterns. Talk a little bit about what actually are they, how do they represent themselves on the charts we use. I'll give you my own personal view on what they show and how we can utilize them. And then I'll talk about how we use market and chart patterns, the different types of them, and also how to trade them in terms of understanding where we get in, where we get out, and where our target would be. So let's start with a little bit of a recap of something that we covered in the last webinar series or the last session, and that leads into talking about market patterns. What you'll find is that when people talk about trading tactics, they boil down to one of two possibilities: break of a line of support or resistance, or a bounce off a line of support or resistance. And it's very important that I want you to understand, and that I actually want you to grasp that. I want you to grasp this as the most simple, basic concept when we look at even just simple market patterns. So it doesn't really matter, what kind of trading and investing method you have. It all boils down to one of those two particular styles: a break of a line of support resistance or a bounce off a line of support resistance. It is as simple as that. And what we want you to do is try and understand that and realize that whatever kind of trading style you look at, that's what invariably 95% of them will boil down to. So it's crucial that you understand when you see those market patterns time and time and time again in any particular market and any particular time frame. As we've stressed throughout this series, what we are sharing and educating you upon are ideas and concepts and strategies and tactics that are time frame agnostic. Doesn't matter whether you're trading 5-minute charts, 1-minute charts, or monthly charts. And also instrument agnostic. Doesn't matter whether you're trading equities, whether you're trading commodities, whether you're trading FX, or whether you're trading indices. We want you to have these ideas in place to be able to help you develop as a trader regardless of what you actually trade. So in terms of those very simple, let's say, market patterns, one of the very simplest ones you'll see is people trading a break of a level of support or resistance. Remember what I said, that's what it boils down to. And very often you'll see that this is, we wanted to show a very simple, US dollar 15-minute chart, okay? It can be any time frame and any instrument. Hopefully you can see that as price has gone sideways and prices effectively, it recognizes these levels of support and resistance. They come up, they show on our charts, and then invariably what happens is there's a break of that, in this particular case, the level of support, and price moves down. That's just a very simple market pattern. It's a very simple market pattern. And as we go through this particular session, we'll actually sort of look at some of our individual chart patterns and how you can identify them and how you can utilize them in your own trading. So that's really trading a break of a level of support or resistance. When we talk about trading a bounce off, well, this is sort of a much longer term chart. This is a euro-dollar daily chart. But what we actually have is, as you'll see, we're always drawing in our levels of support and resistance, always drawing those in. They become what we'd like to think of as almost like static levels of support and resistance. We have a couple of very simple moving averages which become dynamic. And what we can see is time and time again, when price comes up, it bounces off these levels of support and resistance. Whenever price comes up to it, it bounces off it, almost like a ball bouncing off a wall. All right, price comes up to it, it bounces off. Comes up, bounces off. Comes up, bounces off. Comes up, bounces off. All right. So as I say, Market patterns, you'll see they're either a break of a level of support resistance or they're a bounce off a level of support or resistance. And it is crucial to understand that most simple of concepts. Here's a chart I added in here. This is actually a very long. This is like a Kiwi dollar yen weekly chart. And the reason I like to put this in is because this is a weekly chart here. Okay, so actually, what we're looking for is this covers 3 years, nearly 4 years worth of trading action. Okay, nearly 4 years worth of trading action, and it's imperative for us to understand that. It could be a 1-minute chart, or in this case, it could be a weekly chart, and the patterns could go on for for 4 years. Is that we identified that we have a resistance level at 69, and we have a support level at 58, and you can see that basically price just keeps bouncing off it. Price just keeps bouncing off those particular levels, time and time and time again, right? Until it doesn't, all right? So it goes in a bounce into a range before it breaks out and gets onto a new range. But that was 4 years, 4 years that actually moved in that. Now you have to think, if that does that, if that market pattern repeats itself, is that tradable? It is. Very, very most definitely it is. It's fascinating to see, as I said, it doesn't really matter about the time frame, it doesn't really matter about the instrument. These market patterns will occur again and again. So, in terms of, you'll find that some traders actually just trade those particular market ideas, just, either a bounce or a break. Well, the thing is, they both have their pros and cons. That's the reality of it. Some people prefer to trade breakouts. Some people prefer trading bounces. Personally, within my own trading, I prefer to trade bounces as part of a pullback. So I look to identify where a dominant trend is. I look to find a little bit of a pullback, and when that pullback bounces off a level of static or dynamic, support or resistance, that to me is an opportunity to join the trend at a cheaper price. And that's really, what I'm looking to do. And one of the upsides of it is if I'm wrong, I know if I'm wrong much quicker, because if price doesn't bounce strong, or it just reverses, or doesn't go through my particular place that I want to bounce, well, then I know when I'm wrong much sooner, and I'm happy with that. If I'm going to be wrong, I want to know very quickly. I want to keep my my risk to the smallest amount possible, get out, and then move on to the next trade. So that's why I use it. But as I say, they both have their pros and cons. There will be other people who would stand up and and claim that they would never ever trade a bounce. They're always breakout traders. A lot of this is about understanding what type of trader you are. The reality is, if you want to actually find out which one you are, my advice is that you trade 25 breakouts and you trade 25 bounces. Capture all of your records from those trades and start to understand which are the ones actually worked better for you, and which are the ones you found easy to execute consistently, because that is in itself an immensely important part of the process. So had a little bit of a look at understanding how market patterns emerge. But once you start to take these into let's say the next level, you start to identify and develop chart patterns. For those who've never seen or understood chart patterns, it's where we start to use those particular lines of support and resistance. They start to create chart patterns, and those chart patterns can actually be traded. There's quite a few of these patterns, but we tend to group them in 1 or 2 groups. One is either you'll hear a continuation pattern, or the other is a reversal pattern. Well, it shouldn't take you to have to be a rocket scientist to realize that if you're trading a continuation pattern, we are expecting the trend to continue. Whereas if you're trading a reversal pattern, we are expecting the existing trend to reverse. Pretty simple when you look at it, but there's a few different patterns within those particular groups. And what I'm going to do is I'm going to share with you a few of the my particular favorite chart patterns, and hopefully you'll be able to start to see how they show up time and time again on any particular chart. So if you're completely new to trading, all right, and I start talking about bull and bear flags, ascending triangles, and symmetrical triangles as being part of continuations, you may actually be scratching your head and wondering what on earth is all that about. Well, I would ask you to bear with me for a short while, and what you'll find is by the end of this particular webinar, you'll understand what those particular continuation patterns are. Also, you'll start to learn about things like head and shoulders, double top and bottoms, triple top and bottoms, and cup and handles, all right, as tops and bottoms. We'll have a quick look at island reversal, but to be truthful, they're more prevalent in stock trades than in trading FX indices and commodities. As I said, if you're completely new to trading, you may have absolutely no idea what that means, and that's absolutely fine. I would hope by the end of this particular webinar, you'll have had some insight into what those kind of reversal patterns are, and where they show up, and how you can actually start to utilize them within your own trading. So let's start with continuation. All right, remember what I said, a continuation pattern is simply that we expect the trend to continue. So here we have flags. As the name implies, it looks like a flag on a flagpole. So this is a bull flag. Why is it a bull flag? Because price is bullish, it's going up. Then price pulls down here, and this is the flag, okay? This is the flag. It looks like a flag hanging off a flagpole, and then what happens is, because it's bullish, we expect the bull flag to continue north, okay? Simple as that. On the flip side, if you see a bear flag, it's because price is heading down. It then creates what looks like a flag before moving down in a continued downtrend. Simple as that. It's continuation pattern. We expect the trend to continue after the pattern has completed. Very, very simple. This is a very, you'll find this is a very simple pattern, and quite a lot of the people use it. This is a, I wanted to put up a very, very sort of just simple version of this, just a, a very simple version. This is just a kind of 5-minute dollar yen chart, but here's how we do it. When you start to see the actual flag fall, you have a little bit of resistance level to the top, support level to the bottom, and here's how we actually trade a flag. What actually happens is you'll take from a sort of a natural point. It will be the start of the flagpole, okay, before it enters the flag pattern. And then what actually happens is we look to extend, okay, extend the distance that it traveled in. We look to extend that distance how it travels out, okay. Once it, in this case, this is a bear flag that breaks support, and there we have a target that we can use. So, we take it effectively, the flagpole is used as the target. We take that and we project that from the breakout, and that gives us our target level. Not very difficult. As I said, that's for a bear flag, and you would just flip that around for a bull flag. Very, very simple indeed. You can find, on all of these, all of these charts, plenty of bull flag or bear flag. This is gold on a 4-hour chart. We can start to see after being a little bit scrappy to start with, prices start to come up and move in an uptrend. And then what happens, as I said, price moves up, and then it moves back, okay? It moves back in a nice flag, all right? And here's a little bit of a, let's call it a little bit of a trader's tip for you, is that very often some of the good flag patterns, they finish on a pin bar. Don't be surprised if they see that. If you don't know what a pin bar is, then go back and check the earlier webinar series where we covered those. But as you can see, this forms a flag and then basically moves onwards. Now, some people might say, well, actually, Paul, I'm looking at that, and that was actually a flag there. You'll have to excuse my weak artistic skills. But some people would say, well, actually, Paul, that was a flag. And I wouldn't actually disagree with them. Price is moving up, right? It then puts in a little bit of a pullback, which looks like a flag before it takes off again. And what you'll find is that when price is in a strong uptrend or strong downtrend, you'll find that these flag patterns happen, a great deal, and they make very, very simple and easily identifiable patterns that you can take and utilize to get on board that dominant trend. So here's a chart on the D30, which is the DAX, and this is a 4-hour chart, and this is a bear flag pattern, okay? Price has been moving down overall, all right? What will happen is, price moves down, all right? There's your flagpole, and then invariably price pulls back. Okay, it pulls back, and what do we see there? What does it end with? Well, it ends there with a bearish pin bar before it breaks and continues down very, very nicely. As I said, very, very simple to identify. Once you just start looking at charts, you start to very quickly identify where these particular patterns are and how you can actually utilize them, and you'll start to realize which are the good ones and which are the poor ones. Once again, some people might say, well, do you know what, Paul, actually, I'd say that was a flag. And once again, I wouldn't particularly fight you on that. But for me, as I said, I kind of like to see my flag pattern be very clear. And actually, I like it to end on a pin bar as well. It's almost like the kind of the last gasp All right, the last gasp of the previous player before price rolls over and falls away. And that's what I'm particularly looking for. Keep it nice and simple. Keep it nice and elegant. You know, stand out off the chart for it. That's what I particularly want to see when I'm looking to trade a flag pattern. So here's a chart from a different MetaTrader 4, but I wanted just to actually show it on a completely different instrument that maybe you've never even seen before. This is actually Facebook, and what we have here, this is on the weekly chart. You can see price was in a strong uptrend there, and then what happened is price gave a very nice flag pattern, and what do we see there as well, ladies and gentlemen? Well, actually, we see it ending on a very bullish pin bar. Okay, remember we've covered that. Go back, have a look at that. And then invariably what we did, we projected up, and literally it just got itself up there. Now, invariably what I'm normally looking to, if you're looking at really about hitting it about 80% of the target, that for myself is a very sound target, and I'm very happy and comfortable with that. What you want to be able to do is just to ensure a way to trade it so that you have a very good reward to risk. That's what we're looking for, right? We don't want to be risking £10 to make £1. We want to be risking, £10 to make, £15, £20, £30. That's what we're actually looking at how we do that. But that's just a very simple, very different pattern that you can see. And here's one on the this is Kiwi dollar yen again. All right, this is now Kiwi dollar yen is in a downtrend. We can see price moves down, and then invariably it moves up. Okay, moves back in there, pulls back in a flag pattern. What do you know? We also have a little bearish pin bar at the end of it, and we project away, and price moves down to that particular level. Okay, so these happen, as I said, all the time on all sorts of time frames and on all sorts of instruments. So whatever you particularly trade at the moment, whatever you particularly look at, take some time, start to see if you can go through the back charts of your chosen instrument and see if you can identify the flag patterns. I'll bet you'll find plenty of them there. So that was flags. Let's have a look at another continuation pattern, all right? And these ones are ascending and descending triangles. As the name implies, all right, an ascending triangle, okay, what we have is the base of it is constantly ascending, and what we're actually looking for is for price to go up. If we're looking for descending, well, we're looking for the resistance level to be constantly descending, but have a very, very firm, simple base before price actually breaks and heads down. So ascending triangle, we're looking to be bullish on. Descending triangle, we're looking to be bearish. That's the sort of, let's call it the classical chartist way of viewing these. So here's a smaller sort of descending triangle on the pound against the yen. Hopefully you can see that this support level here has been there. It's been going there very nicely. But what you can notice is that every time it bounces off that support level, okay, it's getting smaller and smaller and smaller and smaller, the bounce off it. It's just looking like a triangle, and then effectively price breaks. But price breaks, how do we utilize that? How do we trade that? Well, we're looking to trade the break, and what we do is we actually take the base of almost like the triangle and project that forward from the breakout point, and invariably that gives us a very solid target. Very, very simple. Just look at the base price, okay, in terms of the distance from prices touching the base up to the level of resistance, what that distance is, and project it forward from where the particular level we're looking to break out at, and there you have a very, very simple target. And that's what it wanted to be. We want it to be simple and consistent, because that's really the most important way to deal with it. Here's an ascending triangle. Okay, this is the 30-minute on the euro dollar. We have a resistance level here. You can hopefully see that. Actually, what we've had is the support level, right? Every time price has moved up, it's bounced back. Okay, it moves up, bounces back. It's almost like it's almost like price is coiling up a bit. It's getting ready to blow, and that's what it does. And we see it break out. Okay. And invariably, like the descending triangle, what we do is we take the distance, all right, from the base to the support level, and then we look to project that forward from the breakout spot all right, and that gives us a target. Now, interestingly enough, for a few of you, the smart people who've just had a quick look at this, you might actually even recognise that this here is a very nice bull flag that showed up after it broken out, and you know, what do we know? It's closed out on a pin bar as well. Just a little, you know, little sign there, just to show that, you know, these patterns can flow into each other. They turn up all the time, everywhere in your charts. You just need to train your eyes to be able to see them very quickly and very easily. So we've done flags, we've done ascending triangles and descending triangles. Well, next is symmetrical triangles. And you know, I would expect most of you would understand what a symmetrical triangle is. Very, very simple, easy. So sometimes people will call it a pennant, right? Pennant tends to be a bit smaller, but you know, it shows pretty much the similar characteristics. It's just a symmetrical triangle, right? And as we look at a couple on the charts, you know, it's hopefully you'll be beginning to understand those kind of, you know, triangle patterns. Is that, you know, we're identifying where the resistance level is, we're defining the support level, and when price breaks out, all right, you know, once again we're taking a bit of a projection from the base price target, projecting that forward, and that gives us a target to work to. And that's what we're really looking for. That's what we're interested in. That's, you know, just simple picking up these triangle patterns in chart, and you'll find there are lots of triangle patterns on your charts, and they start to become very tradable opportunities. And you know, what I like to sort of tell people is you've got to think about these triangles. It's almost like a price is coiling up. Think of it, you know, it's like price is coiling up, it's getting tighter and tighter and tighter until then the spring is released, and then your price, you know, it explodes out, and away it goes. And that's what we're hoping for, and that's what we're looking to be in a position to trade. So here's another. This is a bit more of a kind of, let's call it like a shallow one, but you know, the idea is the same: is that we start to identify and be able to, you know, pick up these particular you know, resistance and support lines. You know, they give us an identity. It looks exactly like a symmetrical triangle, and then when price breaks out, we're able to effectively, all right, just gauge from the, you know, the sort of taking from the base price target, and then projecting that similar distance from where it breaks out, and one to learn, that gives us a suitable target to trade with. Very, very simple. So that's what we looked at there in continuation patterns, right? Bull and bear flags, ascending and descending triangles, symmetrical triangles. Very simple. Just take a look on a chart. Just open any chart, any time frame, and just go through it and just start to, you know, test yourself, you know, to be able to identify those particular patterns. Remember what we said, they are continuation patterns, so we expect price to exit the pattern in the same direction, okay, that it entered it. So there's a continuation of the trend. Now on the other side, we have reversals, as the name implies. It's because we're looking to see that trend reverse. And here are a few of the patterns that you'll start to hear traders like myself talk about, things like head and shoulders, double top and bottoms, triple top and bottoms, cup and handle top and bottoms, and also island reversals. So what today I'm going to sort of focus on head and shoulders, double top and bottoms, and triple top and bottoms, and a cup and handle. And island reversals, as I said, you tend to see them in equity stocks more than anything else. But you know, the other ones you'll find there are plenty of examples of that on your normal charts. So head and shoulders pattern, all right. Well, as the name implies, it just looks like a big head and shoulders. This is the dollar yen, all right, on the weekly. Now there's a few parts that go up into you know, finding its head and shoulders. One, we need a left shoulder. Now invariably what happens, you just think about price and action psychology. Price pushes up there, pushes up to a new high, makes a head, and then it rolls away, and then it basically pushes back up again, but it fails to make it reach the old high, fails to make a new high. And invariably, ideally, in a very, very pure technical sense, what we identify as the right shoulder, preferably we prefer to be lower than the left shoulder. Why is that? Well, just think about it, okay? Price has been moving along, and by the time it gets up here, we want it to be almost like the last hurrah, the last gasp of chaos. In this particular case, the bulls, they run out of energy, they roll over, and then it falls away. Now, how do we actually trade it? Well, what makes it easy is we start to identify a very simple neckline, which you can see here. Very simple neckline. All right, they should just, in most cases, stand out apart. And what we take is we take the distance from the neckline up to the top of the head, and then we project it forward from where we break out, and hey presto, we have a target. Now, as a general rule, I would kind of tend to look at trading only about 80% of the target. All right, I like head and shoulders patterns. Head and shoulders patterns show up everywhere, all the time. Most of my own trading is on the sort of like longer term swing charts, like sort of the weekly charts. So if you look at this in this particular case, that took about probably about 13 to 14 months to actually show up and build. All right. So the way I look at it is I get time to sort of set myself, identify the pattern, and be ready for it. I just need an element of patience. But as you can see, when it plays out very nicely, and it can be very profitable. The flip side of a head and shoulders pattern is what you'll hear sometimes called an inverse head and shoulders, right? Why is that? Well, because invariably what happens is we have an inverse head and shoulders at the end of a downtrend. Here we go, we've got the left shoulder, price comes up, then price pushes down, it makes a new low, right, which becomes the head, price pulls back, but then it comes down again, but once again, it can't get to the previous low, and it certainly can't go any lower. And in fact, the low of it, all right, it is just, in this case, it's just literally a little bit higher than the sort of the shoulder, the left shoulder. That's giving us an indication that, all right, the bulls are stepping in here, the bears are losing control, and then what do you know? Price shoots off. Now this one we don't have, this one is a bit of maybe a little bit of a different sort of neckline. It's not naturally horizontal, but that's fine. But once again, we just take the distance from the head to the neckline, and then we look to project that forward from the breakout point. And what do you know? Price goes on and hits there. It's just that these patterns become a self-fulfilling prophecy, especially on the kind of longer term time frame, because it takes a long time to set up. Everybody can see it, so everybody can get themselves ready to get on board the bus. So that's an inverse head and shoulders. Inverse head and shoulders tends to be bullish, and normal head and shoulders tends to be bearish. But hopefully you can see from that they are reversal patterns. Here's one to take away and have a little look at. Recently, this is another inverse head and shoulder, and this is on the UK 100, the FTSE. What we've had is from the recent highs of last year, price came down, it put in a low here, which turned out to be the left shoulder. Price comes down to make a new low, that becomes the head. Price pulls back up, but then it can't, it doesn't go up. It comes back down, and I'm saying, well, this looks like it might be just the right shoulder, and then invariably what we had. The Brexit vote gave us that right shoulder, and I was talking about, if price broke around the kind of neckline about 6,400, that was very positive, and that's what we've seen. Price is broken, okay, it's holding above it, and if it continues to, well, then you start to be looking at, well, crikey, could it go up to attack the recent high? So that's a big old inverse head and shoulders on the weekly. But as I said, one of the joys of that is it takes a bit of time. Everyone can see it, and everyone can position themselves to do well out of it. So, there were head and shoulders. Now let's have a little look at double top. As the name implies, a double top means that price makes up and makes, a double top. It makes a second top. Now, this is the pound against the yen. Once again, on the weekly price, price has been in an overall uptrend, okay? But then price pushes up, make new highs. It comes back down, bounces off, and then it pushes itself back up. But here's the interesting thing, is that it is unable to make a new high. All right, the second high is a little bit lower than the first one, and what I really particularly like is that also that it effectively creates in this particular case a big bearish engulfing candle as well. This is a little bit like the fake outs that we covered in the one of the earlier webinars. If you don't remember them, then be sure to sort of access the work, the webinar archive, and be sure to have a look at them. But there we have is like a double top, right, before price falls away, right? Now some people might even say that, well, Paul, that just becomes a big head and shoulders. That's your left shoulder, that's your head, and that was your right shoulder. And you might say that I'd say that's probably a little bit stretching for it, but I know plenty of traders will stretch for anything. Here's a double top. This is an interesting one. This is the euro dollar, the monthly chart. Something a bit different. You can see that price is just going only one direction, wasn't it? And then invariably what we had was, we had, price pushes up to the highs, it falls away. Price tries to push back up against the highs, it can't make it, and it falls away. And actually, this was the peak of the kind of the euro in the pre-financial crash. Okay, the kind of messy sort of double top there was actually the sort of the end of the uptrend before price crashed as part of the great financial crash. So double tops, and remember the reversal patterns. When you see a good one and a clear one, it's giving you a good indication that basically that trend is over. Now here's an interesting one. This is the Euro CAD, right? And what I want to show you is that this is where a double bottom becomes a triple bottom, right? Remember, it's a reversal pattern. Price has been going down, all right? Price gets down, makes a low, bounces up, pops that down again, and makes a double bottom. Okay, a second low, which is double bottom, before it moves prices back up. And some people have just traded that and been very, very happy. But then price comes back down again, and here we go. It's clearly this level. We've had one touch. We've had two touch, and this is a third touch. It's like a triple bottom, a really big triple bottom, before price shoots up back up to that level of resistance, and then invariably it kind of ends up going up that way as well. So that's how we start with a single bottom, then it goes to double bottom, and then actually it becomes a triple bottom, and that triple bottom is clearly an indication of real support at that particular level. And what I've found over the years is that don't try and fight those big levels of support. Far better for you to actually sit and work with them. So here's the cup and handle. All right. Well, as the name implies, it's just because it looks like a cup and handle. All right. It's a reversal pattern. This is silver. Silver's been a nice downtrend. And then basically what happens is you can see it has a kind of a rounded bottom there. Can you see how it does that? The price comes back up to this level. And then this becomes the handle, all right. So hopefully it's almost you can see that we have the cup there, then we have the handle, and then basically once price breaks that level, then away it goes. Interestingly enough, this price pushed up, then it came back down, it retested that level before it shot up again, which is quite fascinating, really. So cup and handles don't happen, too often, but they do happen. And then normally the good thing on the bigger pictures is that actually they become very, very clear. It becomes very, very clear very quickly, and you're able to see that and position yourself accordingly. And the truth of the matter is that's what you want. So as we draw towards finishing up, what we did is put together two little slides, okay, here that that you could actually just print off and stick on your wall in front of you, and it gives you a little bit of almost like a little aid memoir on how to, what you're looking for in terms of continuation patterns with regards to ascending triangles, descending triangles, uptrend, downtrend, pennants, okay, pennants or symmetrical triangles, flags, and symmetricals. Okay, so you've got that printed off, stick it up on your wall, have it right next to you, so you're able to sort of to look at it and train your eye to be able to identify and understand that. Similarly, we did the same for reversal patterns. All right, you can hopefully see, there's one for head and shoulders, gives you an idea how to understand it. Also, you can see, there's a triple top. All right, V and spike is there, but it's not really, doesn't happen really as often as it used to. Key reversal, does happen, but it's also a very keen index. Very keen with equity traders. There's sort of a bit of an island gap, as I said. That is that you'd get that on you would get that on equities, but not always. It'd be very difficult to get on FX. Right? Cup and handle, well, we can show. We've just seen that. Okay, you can have that with a saucer top. You can have a double top as well. Okay, a double top or a triple top. Will be seen, and you're able to work with them, and that effectively gives you opportunities. And certainly, head and shoulders are one of my own particular favorite charts. It's very, very simple to find on pretty much all charts. So to finish up, okay, markets and chart patterns, they happen on all time frames and all instruments, and that's what we've been trying to share with all of you traders, okay, who, especially those who are new to the market. And a chart pattern is either it's a continuation or it's a reversal pattern. That's it. It's either going to continue with the trend or it's going to reverse the trend. Keep it simple. What actually does happen is it does require some practice to trade well, but it's very, very simple to get the grasp the idea of these things. It's very simple to get an understanding of what you start to see on those particular charts. And once you're able to do that, then it can actually become a very profitable way to trade. Certainly, flag patterns are something that I like to use. Triple tops, triple bottoms, also, and also head and shoulders patterns. I just take a few of those patterns and I work on them till they're honed in terms of my own trading experience, and it's about being able to sort of build that into your existing trading plan. Well, I hope you found that useful. I hope you found that interesting. All right, as I said, take away, have a little look at these, just try and identify those patterns, and realistically, I would suggest do 25 continuation trades and reversal trades, and you can be able to utilize them to give you an idea of how well they trade for yourself. So, as always, I hope you found that useful. I hope you found it interesting and provides you a little bit of insight into understanding market and chart patterns. As always, we wish you the very best of success with your own trading, and keep an eye on the Value Trades website to basically look at the next episode in this price action strategy webinar series. And as always, I wish you the best success in your own trading. Many thanks.